Picture this. You stumble across a company that literally dominates its industry and trades at a massive discount, but it carries financial metrics so utterly terrifying they'd make legendary investors run for the hills. Well, welcome to today's Explainer, where we're decoding a fascinating financial mystery. We are tearing down HCA Healthcare, the largest for-profit hospital chain in America. So, is this a classic healthcare value play, or are we looking at a catastrophic value trap? Let's find out. Okay, let's dive right into this because right out of the gate, we're met with this bizarre, glaring contradiction. On one hand, you got a price to earnings or PE ratio of just 13.7 times. Now, in the healthcare space, that looks incredibly cheap, enticing even. But simultaneously, their price to book or PB ratio is 291 times. And no, that is absolutely not a typo. 291. How on earth can a stock be deeply undervalued and astronomically overvalued at the exact same time? And just to raise the stakes a bit for our analysis today, in the last quarter, HCA suffered a massive $400 million pre-tax loss. The culprit? A sudden, sharp surge in self-pay, uninsured patients who lost their health coverage through the exchange. Suddenly, that cozy low PE ratio feels, well, a lot less safe, right? So here's our docket for today's Explainer. 1. The setup. 2. The prosecution, looking at those red flags. 3. The defense, uncovering the green flags. 4. The judges, Graham, Lynch, and Buffett. And finally, 5. The verdict. All right, let's kick things off with part 1, the setup, America's largest hospital chain. Look, HCA is an absolute behemoth. We're talking about market dominance on a staggering scale here. They operate over 2,500 medical facilities. That's hospitals, ERs, surgery centers, spread across 20 states. They employ a massive workforce of 320,000 people, serving millions of patients every single year. But despite this unbelievable scale and revenues that are expected to hit up to $79 billion in 2026, the stock has really taken a beating lately. It currently sits around $408, which is down 26% from its 52-week high of $556. Moving right along to part 2, the prosecution, red flags ignored by media. Let's start by unpacking those financing red flags, because they are glaring. We already mentioned that mind-blowing PB ratio of 291x. But why is it so high? Well, it's because while HCA owns massive physical assets like all those hospital buildings, they're heavily depreciated on the books, carrying huge intangibles. But it gets worse. They have a return on equity of just 1.36%. You might be wondering, how does a company with a cheap P have barely positive ROE? The answer is leverage. Their debt-to-equity ratio is estimated at a terrifying 7 to 8 times, which artificially pumps up earnings while completely crushing the actual return on shareholder equity. And remember that $400 million loss we just talked about? Yeah, that wasn't just a one-off hit. The company just had to raise its full-year guidance for the impact of these exchange coverage losses from an initial $600 to $900 million, all the way up to between $1.0 and $1.2 billion. This is a rapidly worsening trend of uninsured patients showing up at HCA's doors, forcing the company to just eat the cost. Beyond the balance sheet, there are some really critical operational threats here too. While overall admissions are up, their most profitable services are shrinking. Inpatient surgeries are down 2.3%, and outpatient surgeries are down 3.4%. Add to that, we're seeing insiders jumping ship. For example, a recent $2.5 million stock sale by executive Christopher Wyatt at $504 a share? When you combine shrinking high-margin surgeries, insider selling, a practically non-existent dividend yield of just 0.76%, and 3 separate warning signs flagged by Guru Focus, well, the prosecution's bear case starts looking incredibly strong.
Okay, take a breath. Time for part 3. The defense. The hidden green flags.
Now, what's really interesting about this is HCA's incredibly powerful defensive moat. Guru Focus gives them an 8 out of 10 wide moat score. That actually places them in the top 0.15% of all healthcare providers. They are the undisputed market leader, wielding massive scale advantages with those 320,000 employees. They also benefit from strict regulatory barriers. It is notoriously difficult to get new hospital licenses or Medicare certifications. Morningstar even points out they're one of the most cost-efficient operators in the entire healthcare industry. And because of that recent 26% stock drop, you're actually paying a historically cheap price for this massive moat. Compared to the industry average PE of 26x, HCA is trading at a massive 47% discount with a PE of just 13.7x. Their price to sales is just 1.14x compared to the industry's 2 to 3x. Ultimately, they're offering a 7.3% earnings yield, which, let's be honest, is a highly attractive return for value investors who are willing to look past the debt.
Furthermore, their underlying business is incredibly resilient. Despite taking that brutal $400 million hit in Q2, they somehow managed to grow revenue by 8.7% to $20.23 billion and jump adjusted earnings per share by 11% to $7.59. Overall admissions and ER visits both grew. So how did they pull off this magic trick? Through diversification. That $400 million self-pay hit was almost entirely neutralized by a $400 million benefit from a Florida Medicaid supplemental payment program. It's like a perfectly balanced scale.
And the smart money, they clearly see this resilience. Guru Focus and Wall Street analysts both target a true value around $450. But perhaps the most telling metric here is the ownership. Professional, institutional investors own 95% of this company. They are drawn to the strong cash flow, which creates a 7 to 9% owner earnings yield and a low beta of 0.67. In plain English, that means the stock is historically far less volatile than the broader market. All right, part 4, let's bring in the judges, Graham Lynch and Buffett. And this brilliantly illustrates what happens when you run a complex beast of a stock like HCA through strict investment frameworks. The results are highly polarized. HCA literally catastrophically fails the strict mathematical criteria of both Benjamin Graham and Peter Lynch, but it actually manages to secure a partial pass for Warren Buffett's quality checks. So let's break down exactly what they'd say. For the godfather of value investing, Benjamin Graham, it is a hard mathematical no. He'd look at that balance sheet and say the price-to-book value of 291x is a complete deal breaker. There's absolutely no margin of safety here with this kind of leverage. I'm passing. Next up, Peter Lynch. Now, he loves growth at a reasonable price, so he'd look at the momentum. EPS growth is only 8 to 11%, and revenue growth is 8.7%. He'd probably say, look, the PE should match the growth rate. Here, the PEG ratio is between 2.0 and 3.0. It's simply too high. It's way too expensive for this level of growth. I'm passing. Finally, Warren Buffett would offer a much more nuanced take. He'd immediately recognize that phenomenal 18.5% return on invested capital and that 8 out of 10 wide moat. He'd say, I love the ROIC and the moat, but the ROE of just 1.36% is a problem for me. And honestly, I worry about healthcare policy risk making the business too unpredictable. I'd study it more, but I'd need more confidence before buying in. Which brings us to our final section, part 5, the verdict, moat versus policy risks. Ultimately, HCA Healthcare is kind of the textbook definition of a great business, bad Graham stock. It is unquestionably one of the best managed hospital operators in the world, wielding massive scale and efficiency. But it is operating in a highly policy-sensitive industry strapped with heavy debt. If you're doing your own research on this, and you absolutely should be, keep a very close eye on these key upcoming dates. The ex-dividend date is September 16th, 2026, and the next earnings report drops on October 23rd, 2026. That is exactly when we're going to see if those uninsured patient losses keep growing. Which leaves us with the ultimate question for you to ponder today. Can HCA stabilize this self-pay trend? Can they manage their high debt if profits start to decline? Is this 26% stock drop a massive golden opportunity, or is it a glaring warning sign? Ask yourself, is HCA's 8 out of 10 wide moat worth the 291x price-to-book risk? Thank you for joining me on this explainer today. Make sure you do your own homework, read those 10Ks, and as always, stay sharp.